All right, I've been predicting this would happen. I've been worried that it would happen, and now I'm seeing a proliferation of new bills at the state level uh, that would ban corporate purchases and ownership of single-family homes. And so I've decided I need to just hit every medium I can hit to try to get the information out there about what a terrible, disastrous idea that would be. So let's get into it. First, we need to do a little background here. Um, the United States housing market is basically 70 years into a decline. Net residential investment, if you back out depreciation of houses, the brokers' commissions that are paid on selling new homes, if you back that out of the BEA's estimate of residential investment, we're on a downward slope that's been happening for 70 years. And this shows up also in the estimate of real per capita consumption of housing. This is the estimate of the actual, value, the size, the quality of the housing that Americans live in. It increased linearly along with our incomes up until the 70s. It sort of took a downward trend at that point up until 2008, and then literally for a while after 2008, our actual stock of housing declined relative to population for a while, and it's basically been flat since 2010. Now, as that decline has happened, of course there are cycles, right? There's big cycles back in the 70s, and of course there was this cycle in the 2000s. Now, what happens is when you're deprived of something, just think of, like hyenas on the savannah, right? If it's a dry year and they're having a hard time finding food, when they do find something to eat, all of them are going to come and fight over who gets to have it, right? So what happens is when you are deprived of something, when demand for it has a temporary increase, it makes the demand seem so much more problematic, right? The other people that want homes are become our enemies because we're fighting over this deprived service or good. And so what happens, this bottom picture here is basically how I describe this. If we were building enough housing, if we hadn't put a bunch of limits on how cities can grow throughout the course of the 20th century, the value of housing would be like this blue line here. We would get these cycles. There'd be times where people would demand more housing. There'd be times where people weren't demanding more. It might be that incomes are rising. It might be that mortgage financing is becoming more accessible. It might just be a change in how people value housing. So these cycles happen. And basically, since we've deprived ourselves of enough housing, as these cycles happen over time, the cost of housing has gone up with each cycle. So we notice the deprivation mostly when we're at the top of a cycle, right? So through the 60s and 70s and 80s, you had these little cycles, and then, housing keeps getting a little more expensive. Then we got up into the 2000s, and it was again just a normal cycle like you would always have in housing over the course of decades. But now it seemed so much more palpable, so much worse, right? And so everyone reacted in 2000s, by saying, "Oh, this is the worst cycle we've ever had," and we killed that cycle by killing the mortgage industry, by killing access to mortgages by middle-class families. Now that never really got the cost of housing even back to what seemed like normal because it didn't solve the core problem, which is that we haven't been building enough, that we've been blocking builders and developers from building enough in the cities. So now we have another cycle, and now it's even a worse cycle. Now it's worse than ever. But again, we're not consuming more housing. We're not building more housing. We're deprived of housing, and that's why the cycles keep getting worse. And so now on this cycle, the reaction is, oh, it's Wall Street, right? Because since families that used to get mortgages can't get mortgages, they're not the ones to blame for the high costs. So it must be Wall Street. It must be corporations. So now the reaction is, oh, if we get corporations out of housing, now we'll fix this cycle. Now, if we do that, this will be the last cycle. There's no other form of housing to get rid of. For years we've put limits on building dense infill housing in the cities. We put limits on apartment construction. In the 2008 mortgage crackdown, we greatly limited who can buy and own and live in single-family homes. So single-family homes owned by landlords is really the last form of shelter that on the margin is legal to buy. So once we do this, once we ban corporations, we really legitimately are legislating homelessness. All right, so here I'm going to go over the scale of what happened with the mortgage crackdown in 2008. This is a measure of quarterly mortgage originations expressed as a percentage of the value of the total stock of owner-occupied homes to sort of give a way to compare mortgage originations over time. And before 2008, typically about 3% of the value of the existing stock of owned homes would be originated each quarter, and of that, about 1% was to borrowers with credit scores above 760. About 2% was to borrowers with scores under 760. And that was the case in the late 90s. It appears to have been the case, in the mid 90s, really as far back as we have credit score data. Now, you might think that this bump here is associated with the subprime boom. It isn't. This is actually the refi boom that happened in 2002 and 2003 when interest rates declined. And you might also notice, there's a refi boom here in the 2010s. There's a refi boom here in 2021, 2022. Notice that over time, borrowers with lower credit scores have been less and less able to take that opportunity to refi because they're not able to qualify for mortgages anymore. So really the subprime lending boom happened in this period. It actually wasn't associated with an increased amount of lending to homeowners with low credit scores. In fact, homeownership was declining during this period, the homeownership rate. Mostly the subprime boom was about more reckless terms used by more often by investors, flippers. We all know the story of what was happening at that time. It may be surprising to those of you who haven't seen my work on this that really there wasn't an increase in lending to homeowners with marginal credit during that time. So the quantity of lending happening in the 2000s was about the same as what it had been before the subprime boom and before the refi boom in 2003. Then over the course of 2008, pressure was put on the federal agencies, the FHA, Fannie Mae, and Freddie Mac, that after the subprime boom had collapsed, there was pressure put on those federal agencies to make additional cuts to their mortgage access, which moved them far outside of any pre-existing norms of mortgage lending going back decades. And you can see over the course of 2008, the amount of lending going to sub 760 credit scores was basically cut in half. So that for the next decade, mortgages were only originated equal to about 2% of the housing market, with 1% still going to higher credit scores, and now only 1% going to lower credit scores. And so a lot of bad things happened in the housing market after 2008 that were actually the result of this novel tightening. But all those bad things were just attributed to, to being just the inevitable result of having had the subprime boom and bust. But actually, a lot of the damage, really, I would say almost all of the net damage of lost wealth after 2008 was actually due to this novel, unnecessary tightening of lending at the federal agencies. Now, you can see that here. There's a couple different ways to look at this here to confirm what I'm talking about. In this first chart, this shows mortgages outstanding. So the last chart was how many new mortgages are being made. Fannie Mae tracks new mortgages being made, but they also track just the total mortgages outstanding that have been, originated this year and originated in previous years, right? And so in this first chart, what I've done is mapped those figures to the national data of mortgages outstanding to get a sense of the change in lending outstanding to borrowers with higher and lower credit scores. Now, Fannie Mae has a cutoff at 740, and so that's what I've used here. So lending to all households was increasing during the 2000s boom. That was mostly because homes were getting more expensive because we don't have enough of them. Leverage wasn't really increasing on the whole at the time. Houses were getting expensive, so people needed bigger mortgages to buy them. And that was actually happening at least as much among high credit scores as it was among low credit scores. And you can see here, this is 2007. That's the peak of lending to low credit scores, because over the course of 2008, much of that business was eliminated through the federal agencies. And so from 2007 to 2009, mortgages outstanding as a percentage of GDP continued rising among higher credit scores and now started taking a deep dive among low credit score borrowers. And that has continued in the nearly 2 decades since then. Basically, lending to high credit scores is still as available as it was before. They still need more mortgages to buy their homes because homes are too expensive because we don't have enough of them. So lending to high scores, it remains near the highs, and mortgages outstanding to lower credit scores appears to be potentially at lows, the lowest point it has been since at least the 1960s. So again, if it had followed the trajectory of high credit scores, it would be, again, double or slightly more than double the mortgages outstanding compared to what we have today. And you can see this reflected in other measures, not just in credit scores. So this is a chart from Fannie Mae from their annual reports of the gray bars are their estimate of the average market price of all the homes that have gotten Fannie Mae mortgages in the past. The black bars is each year the average price of homes that are currently getting new Fannie Mae mortgages. And the black line here is the Zillow estimate of the average price of homes across the country. So, 2006, 2007, 2008, prices across the country start to fall. So you can see that in the Zillow data, and you can see that existing homes with Fannie Mae mortgages follow the same trajectory. Homes getting new mortgages from Fannie Mae actually increased in value, right? So at a point where old homes with old Fannie Mae mortgages were on average worth about $200,000. By 2009 and 2010, the average home getting a Fannie Mae mortgage now is over $300,000. These things have tracked together over time dependably, well back into the 1990s. So up through 2007, homes were getting more expensive because we don't have enough of them. And Fannie Mae was making the same mortgages to the same families in the same homes that they had always been, right? But the homes were just more expensive. Suddenly, after 2007, they cut off half of, right, the bottom third of their market, basically, they cut off lending to. And that's why the average home value on new mortgages from Fannie Mae suddenly jumped up, because they stopped lending to affordable houses that would be purchased by middle class and lower middle class borrowers that had been getting Fannie Mae mortgages for decades. So any way you look at it, we had a deep, deep cut in mortgage access. Now this is a chart of home prices, and here I'm charting relative home prices in parts of Atlanta that have high incomes and parts of Atlanta that have low incomes, and I'm charting prices of homes in Los Angeles, the same, the homes in parts of LA where incomes are high, homes in parts of LA where incomes are low. Now, much of the increased valuation of housing was in places like Los Angeles, where low-tier housing was getting more expensive. I've done a lot of work on this. I'm not going to get into all the details on this in this video, but that was happening because of the shortage. When there's a shortage of housing, there's basically a musical chairs game that happens where families are competing for the housing that is there, and it just leads to a lot of trading down, making compromises in the neighborhood you're going to move into, the type of house you're going to buy, and all that sort of weighs on the bottom end of the market. So effectively what happens is prices at the low end keep going up until families at the low end can't take it anymore and move out of the city. So that's what's happening in LA up through 2007. Now that's not happening in Atlanta, because before the crisis in 2008, Atlanta was a city that still was building enough housing. So many cities look like Atlanta during that time. There's really no building boom. There's no relative change in the value of homes. Everything is just normal in those cities until this mortgage crackdown happened in 2008. So the mortgage crackdown hits Atlanta, and cities like Atlanta look like this. The neighborhoods where families can still get mortgages because they have high incomes and high credit scores or can pay cash. There's in both LA and Atlanta, basically nothing happens in that part of the market. In the low end parts of the market where families need generous mortgage access, where incomes are lower, where this mortgage crackdown hit, they were devastated. So in neighborhoods where nothing had happened that was unusual before 2008 in Atlanta, literally we're losing nearly 3/4 of their value at the low end. So it went from nothing, normal, crash. Now LA, low-end homes have been really expensive, and they crashed too, because the mortgage crackdown affected poorer neighborhoods all over the country. Um, but the shortage of housing in LA was sharp enough that they were still elevated. So what happens is if you look at national averages and you average all these different places together, it looks like home values were really high and then they sort of almost went back to normal. But it's averaging very different places with very different stories. It's averaging supply constrained LA that then had a mortgage crackdown and then went about its normal inflation because there's a shortage, and places like Atlanta where there's nothing unusual happens and then we devastate that market. And then now again, Atlanta is getting more expensive because now it has a shortage like LA because owner occupiers in neighborhoods like this can't get mortgages there anymore. Now, what's happening now is you get professors in sociology departments in Georgia that just act like all this was just inevitable, and they start tracking the market here, and they say, oh, well, Wall Street came in and started buying up houses, and then the prices and the rents went up, so Wall Street must be causing home prices to be high. And they're missing the entire story of how it got to be that way. First, somebody has to own the homes. So eventually the homes got cheap enough that some corporate and Wall Street firms were willing to come in and buy them. But rents went up because Atlanta's housing market was destroyed by the mortgage crackdown. This figure basically gives the conceptual way to think about what happened in a market like Atlanta. So in 2005, everything's normal. The rents are at a certain level. Here I'm showing it at about $1,500 a month. Prices are at a certain level, about $175,000, right? And this is basically a market in equilibrium where a new home equal to this home would cost about $175,000 to build. So if rents or prices, go up a little bit in Atlanta at this point, then it triggers the construction of a new home, and basically all this stays at this equilibrium level, and the equilibrium is reached by constructing new homes. So the cost of a new home, the price of homes is basically the cost of building new homes. Now, what the mortgage crackdown did, it didn't do anything about demand for actually living in houses, so it didn't make rents go down. It made prices go down because we took away the ability of families to buy homes. So after 2008, a market like Atlanta looks like this, where the price isn't high enough to trigger new construction, and rents are still as high as they had been. And so it's actually out of equilibrium. It's in this equilibrium because the price is now too low to trigger new construction. And so the only thing that could possibly happen between 2012 and today is that Atlanta had to stop building houses until rents now went high enough to bring this new low price point back up to where it was high enough that builders could build new houses again. So the only possible consequence of the 2008 mortgage crackdown in cities like Atlanta was unprecedented rent inflation, which we have in fact been seeing over the last 2 decades. And here you can see how that played out in the market for new homes. So what I've done here is I'm comparing 2006 and 2017 because in those 2 years, the average house across the country, the average home price was about the same in those 2 years. So it's sort of an apples to apples comparison. And what you see here is that builders were building expensive homes at about the same rate they had been building them in 2006. Homes with affordable prices, the sorts of homes that would be bought by families with credit scores under 760, basically was gone. It was gone. So we've got a haves and a have-nots market. If you can still get mortgages under the new terms, the prices didn't collapse, just like those two markets in Atlanta that I showed. The high-end market prices kept going along, so builders could still build those homes and make a profit. And so across the country, they were building those homes. Across the country, in every city where incomes were lower, families couldn't get mortgages anymore, and so builders couldn't profitably build those homes anymore. And you can see the effect that that's had on rents. Again, going back to Los Angeles, where there's a shortage of housing, there's a musical chairs game that starts where families compete for who gets housing, and the way they compete is how much money do they have to spend on the housing that exists. Families with more income still have to compromise down. They have to buy houses that aren't as nice as the houses they would have liked to have bought, and they may be in a neighborhood that's not quite as nice as the neighborhood they would have bought. And so they bid up the rents and prices of houses in low-end neighborhoods. So where you have a shortage of housing, rent inflation is systematically regressive. So here I've used Zillow data to disaggregate rent inflation. So this blue line is rent inflation as estimated by the BLS. And this is after, subtracting out general inflation. So over this period of time, rents have gone up about 30% more than other prices have. But in high-end neighborhoods, the rents have been pretty flat because families with higher incomes are basically making compromises on the type of homes they're living in, moving down into lower status neighborhoods. And then that causes the rents of the low-end neighborhoods to rise. And basically, in any given city at this point, what determines rent inflation in the poorest neighborhoods is how expensive does it have to be to stay there before somebody else volunteers to be displaced to move into a more affordable metropolitan area. So we couldn't build affordable homes anymore because the buyers couldn't get mortgages, and that systematically, inevitably, had to lead to regressive rent inflation. So this chart shows the effect of the mortgage crackdown on household formation. So for decades up till 2008, there was a slightly downward trend in adults per household for various reasons of demographics and the effect of increased incomes on how many multi-generational households there are and things like that. So there's a slight downward trend in adults per household, and then that immediately reverses in 2008. And since 2008, the number of adults per house has been increasing. Now, part of that is that there's been a little bit of increase in adults per occupied home, and a lot of that is that we're basically harvesting all of the vacant homes because we've been building at far below a sustainable rate. So the adults per home, taking all houses into account, has had this dramatic shift in the trend. The chart here on the right basically shows how many homes that change in trend amounts to. So from the 1960s up till 2008, we were never very far away from that linear trend in the number of adults per house. And then suddenly, construction collapses, families stop forming new households, and it skyrockets, right? So this change in trend on the left chart equates to about 15 million homes that are missing. When the mortgage crackdown happened, we basically permanently removed some millions of households from the set of households that can get a mortgage and buy a home. So for about a decade after that happened, there was just an adjustment. Those households becoming renters instead of owners. And so home ownership flatlined. Of course, there was a lot of foreclosures, people losing their house during that time. So for the first decade after the crackdown, every new household on net was a renter. And you can see here in the chart on the left, this is the percentage of single-family homes that are rented versus owned. And so when prices were collapsing, right, in the poorer neighborhoods like the one I showed in Atlanta, institutional buyers were coming in, landlords were coming in and buying the homes and renting them out to the families who now aren't allowed to be owners. Now that process, that was sort of a one-time shock that ended around 2014, 15, 16. And since then, everything is reversed. Now, for this whole period of time, household formation in general has been stunted. But for the last decade, the new households now have gone back to being homeowners. And so it's actually homeowners that are pushing prices up and claiming the stock of existing homes. So at this point, the percentage of existing single-family homes that are rented is actually lower than it was in 2010. All the new demand now is homeowners, and renters have flatlined. That doesn't mean that there isn't demand for renter households. There are millions more renter households or potential renter households than there used to be because of the mortgage crackdown. It's just that we collapsed prices in the poor neighborhoods. We collapsed construction of entry-level single-family homes because the prices are too low. And so all the demand, if it can be expressed by home buyers, they claim the quantity of homes, and we're building about 1 million new single-family homes a year that are being claimed by the families that can still get mortgages. Apartments top out at a little less than 500,000 units a year, mostly because municipalities won't approve any more than that. So we have 15 or 20 million homes that we need to make up. We probably need to build somewhere around 1.5 million, 2 million homes a year to account for population growth. Um, and it's basically all a shortage affecting renters at this point because we won't let those families be homeowners. So the home buyers are claiming the quantity. The renters are being basically squeezed into a smaller and smaller stock of homes. Basically, up till now, what's happened is rent inflation is very high and is very regressive, as I showed you. And so, again, like I mentioned earlier, in a city like LA, rent inflation has to be high enough that somebody's forced to leave the region entirely. Across the country now, that option has basically been taken away, and now rent inflation has to be high enough that just somebody doesn't form a household. And that's all basically happening within the set of renters. If we built more housing, there would be mostly more renter households because they're the ones that have been so affected by the mortgage crackdown. So single family homes built for rent has always been a niche market. It hasn't ever amounted to much because households prefer to be owners and landlords prefer to manage apartments. We've limited the ability of both of those markets to meet demand. And so, as I described, we've had a decade of unprecedented, highly regressive rent inflation that's been driving up the price of low-tier single-family housing, and it has now started to recover back to a point where home builders can build new single-family homes for this one remaining segment of the market that can legally be expressed, which is institutional landlords buying the houses as rentals. So this niche market suddenly, about the time that we were dealing with the COVID shock, suddenly sort of hits that tipping point where there's several cities now where low-end homes are expensive enough, they have high enough rents that those institutional landlords can pay the builders enough to build new housing to meet this market. So now it looks like it's shot up out of nowhere. And what I want to impress to you is this isn't coming out of nowhere. This is a market where demand has been increasing significantly for a decade, but that increased demand has all just been expressed as rent inflation. Now we've hit the tipping point where it can be expressed through new quantity, but the quantity has to be built for landlords because we won't let those families get mortgages anymore. It's the only way to meet the demand in a way that's not just creating inflation. So what I want to impress on you is that this is going to keep happening. This isn't an anomaly. This market is going to grow by leaps and bounds, and it's going to be shocking to people. And people that are already upset about it and have all the causality backwards and are blaming the landlords for the problem are going to be shocked by it. And there's going to be a lot of political pressure to end this, to stop it from happening. And this is literally the one last way we have left to build housing for American families. It would be a disaster to stop it, but the pressure to stop it is going to be tremendous. Now, some people will say, well, what if we just make it so that they can't buy existing homes, but we still let them buy new homes? I would say if you insist on taking poison, I guess watered down poison is better than taking a full dose. If your constituents insist on you feeding them poison, I suppose the watered down poison is better. As I've outlined here above, institutions buying the homes isn't actually a problem. They've been net sellers. The households that can still get mortgages have been the net buyers in the market for many years now. So it's taking poison with there's no problem it's going to solve. And so however these bans get passed, if any of them do get passed, just the one last thing I would want to leave with you if you're a policymaker is to please take accountability for this. If you end up voting for or supporting one of these bills that bans investor purchases in any way, and you find that after the ban is in place that rent inflation kicks back up, that entry-level homes aren't being built, if you find that it hasn't fixed any of these problems, if homelessness continues to stack up in our parks, I would just beg you to take accountability for this and as quickly as possible reverse it when you see that it hasn't helped. If that's the best we can do, I just ask of you to do that. these bills will be very, very damaging, and this market has bent as far as it can bend. There aren't any more vacancies left to harvest. Every marginal point of policy damage we put on housing is going to be immediately felt with bad outcomes. And when those outcomes happen, then we need to be accountable to reversing the damage as quickly as possible.